Hello, today our webinar is all about charitable giving, and we've got Erin Jones, who is the Director of Gift Planning at the Salvation Army. Erin, thanks for being part of the show.
Thank you so much, Al.
And I think I want to start very basically. So what is the Salvation Army? What are they all about?
The Salvation Army has been around for 150 years. Our mission is quite simple. We grow saints, we save souls, and we help the less fortunate.
And so how can people give to the Salvation Army?
They can write a check, they can donate stocks, they could give us their household items. There are many ways you can benefit the Salvation Army to help us fulfill our mission.
Okay, well that's great, and I think a lot of people understand that, but they may not know about some of the more advanced strategies, so let's get into that. Let's start with bequests.
A bequest is a great way to leave a legacy. For people who've been giving for years anyway, why shouldn't it be part of your ongoing legacy? Put a simple bequest in your will, in your trust. It's revocable and changeable at any time in the future. You keep control of the asset during your lifetime, and then at the end of your lifetime, you become a philanthropist.
And of course, you can bequest virtually anything, but you can also bequest your IRA. How does that work?
Oh, absolutely. An IRA is one of the most beneficial assets to give to a charity. If you bequeath your IRA to your loved ones, there's a chance of double taxation, income respect of the decedent. By giving to a nonprofit organization, you avoid all the taxation, so it typically is a wonderful asset to donate to charity.
Another way to give is a charitable gift annuity. So what is that and how does that work?
A gift annuity is a very simple contract. It's a minimum investment of $10,000. The $10,000 is put into what's called a charitable gift annuity. The interest rate you would receive off of this is solely based on your age. So senior citizens love these. Our minimum age is 65. If you're in your mid-80s, you can expect approximately a 7.6% fixed guaranteed return. Interest rates go as high as 9% for 90-year-olds and above. You cannot outlive your income stream. You receive an immediate tax deduction. You receive an income stream that never changes. Part of your income stream is considered return of principal, therefore it is tax-free to you, and you become a philanthropist.
Now we've got an example on the screen. So if you give $10,000 away in cash, how does that work?
We create a one-page simple contract. You would sign up for it. We would pay Mary Rogers, in this case, she's 85, a 7.2% annuity for the rest of her life. Her income stream will not increase, it will not decline. It is guaranteed if she lives till 155 or the day after she signs the contract goes to her great reward. Then the money would be used for charitable purposes. Again, at $10,000 is our minimum investment. She'd also obtain a $5,300 and change tax deduction that she can use in the year the gift is established and carry it forward for an additional 5 years. Although it's an annuity of 7.2%, which would pay her $720 per year, the tax-free amount of that is 82.6%, and this would continue towards her lifetime. So even the payments are taxed quite favorably. If you factor in all these tax advantages, Al, it's as if she's getting 11.2%. And tell me, where can you get that return nowadays?
You know, that is pretty amazing to get a big tax deduction, in this case $5,300, and you get a lifetime payment stream, and it's tax favored because some of that's return of capital. It's a pretty good deal, and in some cases, I think most people want to do this because they're charitably inclined, but this actually works out pretty good for the donor as well.
Absolutely. People love charitable gift annuities. And to add a little more of a bonus to it, if you were to fund this with an appreciated asset such as stocks, you'd actually bypass the capital gains in addition. So that's a way to get a lot of bang for your buck.
A double benefit.
Yes.
Now the next one I want to talk to you about is what's called a charitable remainder trust or charitable unit trust. How does that work?
It's very similar to the gift annuity. You would give an appreciated asset, and typically that's in the area of about $100,000 or $150,000. It could be appreciated stocks, it could be cash, but most likely it's appreciated stocks or even rental income. In this case, we have Joe and Mary. They've been property owners for years. They've been landlords. And you know what? They don't want to do that anymore. They want to travel and join their grandkids, and they don't want to be property managers. But they know they're going to be hit with a very significant capital gain tax on $1.6 million. By transferring it into a charitable remainder trust, they will receive a income stream off of that for the rest of their lifetime. In this example, we've used 5%. It's an honest return, it's reasonable, and given that, it probably will grow over time. The Salvation Army has a 50-year average of netting 6.9%. So in this example, most likely the trust will grow over time. They will receive more income most likely than they're getting from rents in the first place. The income stream will last their lifetime. They'll get, again, an immediate tax deduction they can use the year the gift is established. It can be carried forward. They'll avoid the capital gains on the onset. Part of their income stream will be considered capital gain, which we know is typically taxed a lot lower than ordinary income. Then at the end of their lifetime, the amount of the trust that's remaining will go on to benefit the nonprofit organization they've chosen, such as the Salvation Army.
Yeah, and this really, it's a great strategy, and I kind of want to reemphasize, if you're a property owner or if you got appreciated stock that has a lot of gain, but a lot of the people that we talk to that own property, they just don't want to sell that property to pay all the tax. You can actually create a charitable remainder trust. You put the property in the trust, as Erin just said, and then the trust can sell it. The trust is tax exempt, so it pays no taxes currently, which is a great thing. And so now you got this $2 million property. You've got closing costs, but you don't have to pay any taxes. So you're left with the net proceeds to invest how you see fit, and then you get an earnings stream for life, and that earnings stream is a combination of earnings and principal. And in many cases, you're getting a lot more in earnings than you would have gotten had you sold even without taxation. But you get this big earnings stream, and then when you do pass away, what's remaining in the trust goes to charity. That's how it's tax exempt. But in many cases, these are designed so that 90% of the principal comes back out to you over your lifetime. And this is, I think, another example, Erin, of it's a type of a way to give, but in many cases, you really end up helping yourself and or your family as well.
Absolutely. And the other thing is there are people who have children who say, I really don't want to give this asset away because I want to give it to them. There are strategies in which we can use different type of insurance products to replace that asset for the children and still make the gift to charity.
All right, Erin, well, that's as much time as we have. Thank you so much for what you shared. I think a lot of our viewers, this is really good information. And if you would like more information, go to purefinancial.com. I'm Alan Clopine, co-CEO of Pure Financial.